Hello, it's Adil bringing you a review of the FTSE 100, a weekend review of the UK stock market for Monday's trading, the 12th of January 2015, bringing you an onto market analysis outlook for the week ahead. Okay, so let's start with fundamentals. Let's see what's going to be the overriding factor. Okay, first of all, QE from ECB. It's a watered down version. Okay, it's been discussed that there's going to be 500 billion, and out of that 500 billion, it's not going to be the European Central Bank that takes the risk. It's going to be national banks 50%, and obviously the ECB 50%. So whether or not that's being interpreted as bullish or bearish is still debatable, because we have the other factor. Okay, with regards to obviously Grexit phase in the background. Now, just something that I've just tweeted now. I mean, Syriza leader Tsipras, Grexit is over, Samaras exit in sight. That's not exactly a positive a headline to come out. So he's claiming that obviously Greece has already left the Eurozone, and now it's time for Mr. Samaras, i.e. the party that's currently ruling Greece, to actually leave as well. So it's not exactly bullish. Okay, adding the fact also that there's another article with regards to, I mean, this is regarding Samaras now. He's changed his tune. All of a sudden now, he basically states Greek PM offers to ease austerity to head off Syriza challenge. So what's the difference between Tsipras and Syriza now? I mean, and Samaras, sorry. I mean, there's nothing now, is there? I mean, because the whole concept of the stock market being concerned about Mr. Tsipras, and obviously his party, basically his Syriza party, basically is it's basically the fact that they are going to be anti-austerity. Okay, they're not going to adhere to the tax cuts. Sorry, they're not going to obviously adhere to the tax cuts which Mr. obviously Tsipras wants to obviously employ. Okay, so the whole concept is that the pensions and obviously tax cuts, that's the whole issue. I mean, the whole concept is that obviously Mr. Tsipras, who's a Syriza leader, okay, states that he wants to implement tax cuts, which means less revenue. Less revenue means obviously the balance of budget's deficit, and therefore it doesn't allow them to pay off the debt. Obviously, with regards to pensions as well, I mean, if there's a pensions overhaul, obviously that again reduces the or increases the debt, should I say, and basically that then obviously neutralizes their ability, if they ever had any in the first place, to actually pay off the debt. So again, that's risk off negative. Okay, so you have Grexit fears that are being obviously amplified now. Okay, with regards to the U-turn from Mr. Samaras, so that's not exactly promising for the stock market, and that's going to obviously increase fears and tension. Okay, so then we have Grexit fears, we have obviously terrorism fears, as we all know. So we have terrorism fears as well, because you've got this 2 million or 1.5 million man march in obviously in France right now. Obviously with regards to the Charlie Hebdo killings, etc., etc., and given the fact that these terrorists now have increased their threat levels, etc., against the West, and that exactly is going to create a lot of unease and a lot of uncertainty going forward, and that's not exactly positive for the stock market. So again, that's a negative sign. Also adding the fact with regards to US jobs on Friday, that exactly wasn't interpreted bullish. I mean, one can argue, yes, obviously Greece, the terrorism fears from France obviously were in full swing, and obviously with regards to those idiots loose, morons loose, and they were obviously on the verge of being captured, and obviously they were killed as well. Thank God, they were neutralized. So I mean, it's again very debatable. One could argue that obviously that was the overriding factor. That's why the jobs report wasn't considered to be bullish. But the whole concept with regards to the jobs report again is, okay, you have stronger jobs. What does that mean? Stronger jobs means that the Fed is hawkish. The Fed is hawkish. That means interest rates are going to rise faster. If interest rate rise faster, higher costs of obviously financing, and therefore higher interest rates reduce disposable income, and reduce and eat into corporate profits. So that again, is that bullish for the stock market? No, to a certain degree. Adding the fact also with regards to wage growth, no, not being there either. So that's not a good sign either. I mean, a healthy economy, if it's growing, must have wage growth, and that's not the case. Even though they are arguing that a lot of the elder individuals left, and the elder individuals represented majority of the wage growth, and therefore if they're out in the market, etc. There's always an excuse. Okay, whenever we get poor retail sales, oh, it was the weather. Okay, so again, it's there's always an excuse for that, but that's basically what we have to do is assess the facts for what they are, and that's basically what we see and what I can see from my perspective. Okay, so now that I've discussed all the overriding concerns, basically one would conclude that it's a risk-off scenario. If it's a risk-off scenario, the FTSE is going lower. Okay. The only situation or the way in which that will shift is if Asian markets obviously interpret all this news as being positive, because that's a litmus test. Okay. If they interpret the news as being positive, then obviously I'll change my bias, because Asian markets dictate, because they take all the variables that I've explained, all the fundamental variables, they then process that within their trading system or their array of traders that they have. And if the traders in the Asian markets perceive and understand all those factors to not be overtly bearish and do not deter them from buying the stock market, i.e. embracing risk, then obviously I'll adjust my stance accordingly, and I shift my bias, because that's what we do as day traders. We're flexible, okay? We're not stubborn. We don't marry an opinion or marry a position. All we do is we get in and out, and we're surfers. We ride the wave, okay? So I'll be more than happy to ride the wave. Obviously, if you get stronger economic data out overnight in Asia, and obviously the concerns with regards to France are being alleviated, maybe the Grexit situation may change, and Germany might come onto the table. With regards to QE, there might be more pro-QE comments, and that can obviously shift the bias and sentiment in the market, and obviously I'll be more than happy to go along. Okay, I'm not a bull, I'm not a bear, folks. Okay, I'm just a trader. I'm a day trader. I'll go in any direction. Okay, right. So now that we understand the fundamentals, I've elaborated upon them. Majority of you that are watching this video more than likely have read the articles over the weekend. I mean, generally speaking, my news source generally is my Reuters Icon platform. Obviously, I use Market Watch, CNBC, Telegraph Finance is very good, Financial Times is very good, Bloomberg, obviously we all know, the Standard, okay, and just generally the gist, okay. And obviously TweetDeck is very important as well, folks. Make sure you obviously get that extension onto your Google Chrome browser and use that as well in terms of chronology of news flow. It's very important for you to, if you miss a trade or if you miss a certain direction of a variable, then it's always good that you can go back in chronological order and look at the Google Chrome extension, which is TweetDeck, and that gives you it's like the breadcrumb trail. I can't remember the cartoon now. I was reading it to my daughter the other day, of when an individual goes into the woods, or a girl goes into the woods and she gets lost, and she leaves a breadcrumb trail behind, so she has the ability to go back and obviously find her original destination, well, not destination, but where she set off from. So same thing with regards to the market. It always leaves a breadcrumb or a trail behind, and that's our job to actually read between the lines and understand exactly which way the market's going. Okay, right. Now that I've discussed fundamentals, overall conclusion is risk off. Now let's look and let's interpret the technicals now. Okay, so FTSE 100, we obviously held a 75% fib. We're in this symmetrical wedge type formation now. Basically, bulls are certainly in control, provided the lower body of this candle holds. So we want 6420 to hold on the FTSE 100, and then the bulls are in control. And then one could argue, yes, we have a bull flag scenario, and then we're going back to retest this high up here and the 200 MA back at 6650. Okay, given the fact that the jobs data was strong enough to sustain the economic machine, which is America, obviously, and that helps the world go round. And if we do get some more positive news with regards to QE from the ECB, etc., and that obviously keeps the Kool-Aid trade alive and the markets continue to rally. Okay, that's just giving you a utopian a backdrop to a market that's going to be bullish, and that obviously isn't the case, because we have Grexit uncertainty phase with regards to Grexit, and obviously terrorism phase now as well, that have been exacerbated. Okay, right, so 75% fib, obviously that will be your resistance level for now, the 50 MA. Obviously a downward sloping diagonal trend line and this symmetrical wedge, so you're looking at sideways potential trading now. So it's going to be whippy this week, because the market's more than likely going to move on any type of news event or news announcement, or whether it be geopolitical or socio-economic, either or. Okay, right, so that's basically what we know. Okay, so 6420 is a lower body. Obviously if the market creates an outside bar, then obviously this bullish candle is negated, and this whole thrust higher is obviously put into jeopardy, and the bulls certainly lose the upper hand, and then obviously we're at the mercy of this symmetrical wedge, whichever way it breaks. Okay, that's your daily chart. Okay, Let's have a look at the FTSE 250 now, just to confirm the move there. Okay, so FTSE 250 obviously holding this resistance level, so one would presume and assume, therefore, if that's the case, then the FTSE 100 will remain and under pressure, provided obviously this resistance level holds. If this breaks and breaks out, then that's an early warning sign that the bulls are back in control, and watch out for the move higher. Okay, next move is FTSE 350. Okie dokie. Same thing with FTSE 350. We've held the fibs to 75%. Okay, and it's all about this green candle, and obviously we're in this symmetrical wedge type formation, and that will dictate the move going forward. Okay, let's get rid of these now. Don't need these, don't need that. Okay, so that's basically where we are on the daily chart. The other one that's interesting I always look at is obviously the FTSE AIM. The FTSE AIM has put in a double bottom, and obviously this one could argue this is a higher low, but again it's into diagonal trendline resistance. So until this breaks out this key trend line, then obviously I'll keep my judgments of being bearish. But having said that, given the fact that it's a higher low, that does need to be respected. But again, fundamentals always trump technicals, and as we all know, Grexit and terrorism phase and global growth phase and ECB lack of QE phase. Everybody expected the ECB to do $1 trillion QE, and it's only doing half of that. And even then, it's not doing full QE because it's going to place the emphasis on national banks. And when national banks are already bankrupt, they can't afford to take on more risk. They all wanted the ECB to take the risk, so they obviously remain risk averse. So it's risk free, shall we say? So that again, it's up to the market how it interprets that. From my own basic understanding of economics, based on my degree, when I did economics BSc, it basically states that obviously it's all about lack of expectations, or expectations failing, okay, and not enough money to support the eurozone, especially in time of obviously terrorism and Grexit phase. I think they did need to throw the $1 trillion obviously package, but they've obviously gone for the 500 billion euros, which, to be honest with you, sounds ridiculous because God knows how many other packages they've thrown at the European markets. So again, interesting, very interesting. Now, given the fact that obviously we've had this article over the weekend as well, this is quite interesting, that many European banks are preparing themselves. So 2011 flashback, this is run by Ramsquark, basically stating banks ready contingency plans in case of Greek Eurozone exit. Now, why are they preparing themselves? That's the question you need to ask yourself. That's not a very good sign. Okay, so a lot of these individuals obviously know what's happening in advance, and it's no conspiracy or no coincidence that Santander was having problems last week. Okay, so there's definitely something up with regards to the banking sector, and we'll discuss that in very, very shortly. Okay, right, so that's basically what we know of. The FTSE volatility index is always key and important to understand as well. Again, you'll get this with Pro Real Time. We seem to be making a base on a 60-minute chart, and it does look as if it wants to move higher. So again, that's something that I'm going to be keeping a very, very keen eye on with regards to FTSE volatility index. But we certainly seem to have based and potentially come back to test the 22, 24 level. If that's the case with Grexit and terrorism, etc., dominating, then that means the FTSE is on its way down as well. Okay, that's important. Right, let's go to the smaller time frames. Actually, before we go to the smaller time frames, let's look at the sectors in and of themselves. Okay, so we do know this is the pharmaceutical sector, which I'm showing you right now. Okay, and this obviously has been holding this potential resistance. There's a unfilled gap below, or sorry, above and below. So above and below, there's an unfilled gap, so that needs to close. So certainly a breakout here. Okay, so we need to watch out for the pharmaceutical sector. It's going to be very interesting. The banking sector remains weak, as we already know why. Okay, we've already discussed the concept of why the banking sector is weak, and obviously given the fact that you've got concerns with regards to banks, etc., I find it very hard to believe that this market is not going to go lower in terms of the banking sector. One could argue, given the fact that we've had to sell off recently, the market's already based that in. I don't think, this is new news. Okay, so this certainly needs to be factored in. So again, that's going to be negative for the banking stocks, especially with regards to Santander last week. Oil and gas, obviously, we've had this nice little run. It seems to have broken this wedge. Seems to have broken this. What you can call it an expanding wedge type pattern. Okay, so a rising, contracting wedge pattern. Obviously, we broke down. It's another bear flag scenario, potentially going lower. You've got this support up here, and then obviously you've got this support here as well. So these are two support zones that we keep an eye out for. Right, the retail market. Retail, as we all know, we've got absolutely, well, basically under the cosh, given the fact that Tesco got downgraded, and obviously retail, Marks and Spencer's already under the cosh. and this itself is not looking good from in terms of retail. So this is potentially very very negative sign, and you are looking for a potential move lower potentially. Okay, so again, it's not looking it doesn't look or bode well for the retail sector at present. Okay, the next one that we look at, let's have a look. Okay, construction, as we all know, with regards to the actual US and the situation there as well, with regards to the dollar, etc. This itself, given the fact that you've got geopolitics and socio-economic concerns, the dollar will catch a bid. Dollar catches a bid again, given that with regards to economic data last week, it does raise the potential there for higher interest rates, and that obviously will feed through into the US markets as well. And that, again, overall is potentially negative because the whole talk is about rising interest rates. So again, that's not really good for the house builders there in the UK. So again, this will potentially come under pressure, especially given the fact that it's got an unfilled gap below, which definitely needs to close. That's a very very important factor to watch out for. Okay, let's have a look at the other sectors. Okay, hotels and travel, again, very negative, not exactly a positive sign there. Mining stocks, we did try to make a move or pull back, but obviously that's failed, and certainly hasn't transpired very well. Okay, so again, they are all every single one of them are indicating potential buying scenario, so it's not a positive sign. Okay, so 10-minute chart. Right, where are we? We've got this key trend line. It's actually negated that now, and obviously gone below, hit the 200 MA and bounce, which it usually does. And it's the whole talk now on the 10-minute chart is going to be about this gap fill at 6420. If we get the gap fill at 6420, then obviously we'll move forward. Until then, it certainly looks very very bearish. Now, obviously we've broken out of this bullish channel, and then the market fell, which I mean, it depends on which trader was focusing on that on time. And then obviously we've got this H&S formation as we speak. This is your right shoulder, and the market goes lower. Okay, we take the pivot high, we take the pivot low. Okay, so you have this H&S formation. So the market's made higher lows, had this hold on to resistance, and now making a H&S. Now the pivot high on the H&S is 6580. The pivot low on the H&S is 6520. So you're looking at a 60-point move. So 6520 minus the 60-point move, you're looking at 6440. Okay, given the fact that we've gone below to 6470, and the 6420 is your gap fill. So again, that's going to be very important with regards to gap fill. Keep an eye and focus on that as to which way the market goes. Okay, so that's your right shoulder. Then obviously the market goes low, so 6560 down to 6470. Right. Okay, interesting. So we went as low as 6520. Okie dokie. Right. So that's basically where we are. So H&S formation, and looking for 6440 potentially. Obviously, it's just further down. 6420 equals gap fill. So that's exactly what I do expect to happen, given the fact that this diagonal trend line obviously has failed. Okay, so look at a 60-minute chart now of the FTSE 100. 60-minute chart, potential bottoming tail there. So again, that's certainly a worrisome sign for the bears. Sorry, bulls. Okay, I mean that's not sorry, bears. Do apologize if you're shorting the market. So potential, obviously, a bottoming sign, and obviously one can argue that overall there is an inverted head and shoulders, but given the fact that fundamentals dictate, we are looking for an emotive sell-off come Monday, and we do expect to move lower as well. So that's something of interest to you, and that unfilled gap must close below. So we're looking at the gap being closed around the 6450 level, if not lower. Okay, so that's basically where we find ourselves in. Okay, folks. So risk on, risk off, wax on, wax off. Goodbye.